However, there are a couple of important points that are worth making. The first being the client voice. So as we all know, the client voice is an echo of what the client has said to us as part of that fact-finding process. So in this case, with client-directed cover, it's important that the advisor get the client voice right. So in this example here, we can see that the client has told the advisor that they've purchased a new family home. Cash flow is a little bit tight given the wife is on maternity leave at the moment, and the advisor thought that it was important that in the event of the unforeseen occurring, that the family be protected. What's really important here is as part of that process, the client has told the advisor that they want $1 million of death and disability cover to ensure there was enough funds there to pay down principal place of residence and provide the family some emergency funding. So being really clear with the advisor in regards to what they were after. As we then know, the advisor voice is where the advisor will then capture the conversations that were had with the client. And as we can see in this case, it's been quite holistic in regards to insurance. There's been discussions around life, TPD, trauma, IP. They've discussed different ownership structures and the need to complete a needs analysis. And given the conversations they've had around ownership structures, contributions were discussed, and the way premiums could be funded. So as we know, once we've had that conversation with the client, we'll then move on to the agreed scope. And in this case, you can see that the advisor and the client have agreed that the scope will relate to life, TPD, IP, ownership of the policies is really important, the needs analysis again, and in this case, given the ownership conversation, the way premiums are going to be funded. So being really specific around what the document's going to include. As we know, any areas of advice that are not included need to be excluded. And in this case, given the conversation they had around cash flow initially as part of that client voice, we can see that trauma has been excluded and contributions have been excluded. It's important when you exclude a piece of advice, you capture why it's been excluded, the potential risk of excluding that advice, and then even things like potentially when it might be reviewed down the track. So in summary, again, not too different to what you would normally do, really important that the client voice captures what the client wanted to do in their own words, and then this will allow you then to move forward with your objectives and your recommendations. So now we've demonstrated the scope of advice really clearly and agreed with the client what we want to do. How do we demonstrate this in our objectives in a SMART format? So you can see in that first objective there, given what the client and the advisor have agreed to, it's been really clearly stated that the advisor and the client have agreed that in the event of death and permanent disability, the client required at least a lump sum of $1 million to assist with the repayment of debt and to provide emergency funding for the family. So again, it's a link back to the client voice and the agreed scope. There's an objective there around IP, and then again that last objective relates back to what was agreed upon and is important to the client, is that any policy should be structured in a manner that doesn't impact cash flow where possible. So again, really clear link back to the client voice and the agreed scope of advice. So the needs analysis. Generally, as we know, we would normally follow, the needs analysis we'd normally done as part of that fact-finding process. But for today's purposes, I've just followed the format of the SOA. So needs analysis is one area where advisors still fall a little short on. And we're going to work our way through what a needs analysis should look like. So as per our business policy, a needs analysis must be completed in full in every instance. It is a necessary component to identify the actual cover required by each client, and it's considered an integral part of reasonable inquiry. So as you can see, the needs analysis that's on the screen at the moment demonstrates a fully completed needs analysis. and it will help you demonstrate that you've considered the client's relevant circumstances. So what I thought we'll do is just work our way through this example needs analysis and pick on a few points that are worth making, and that you should be including as part of your needs analysis conversation. So as you can see, the advisors capture the client's liabilities. There's some income replacement and some education expenses replacement there. There's some funds there for other provisions, and there's some existing resources there that have been captured as well. And he's done the same there for TPD and trauma as well. The important aspect to this is the key assumptions and notes that you can see under the table. It's really important that you make it clear how you arrived at those figures. So in this example, for debts, for example, the advisor has made it really clear that the 900,000 has come from the client's 600,000 debt on their principal place of residence and the 300,000 on the investment property loan. For income replacement and education expenses, you can see there's some calculations that have been done there to determine those figures, and I'll come back to those in a second. Other provisions is funeral benefits, and the existing resources of disposable assets is the client superannuation balance. I wanted to touch on points 2 and 3, which are the calculation methods. So we allow for 2 calculation methods. The first one, and probably the simplest one, is that for any figure under 500,000, you don't need to use a calculation method, as you can see in this example. You can simply work that figure out based on the amount required by the years. So in this case, the advisor simply could have done 10,000 per annum over 10 years and come to a figure of 100,000. In this case, he hasn't. He's decided to use the calculation method, but under 500,000, you can use that simple method. The calculation method is the second way to determine that figure, and generally it'd be the amount required by the years, by a CPA rate of return, and then by an annual rate of return. That annual rate of return can be linked to a risk profile. We suggest potentially using a conservative figure, if the funds are going to be held in cash, and that's the conversation you've had with the client. However, that's the method you would use there. So you can see now that the advisor has completed the needs analysis in full, and he's captured some notes and assumptions around how those figures were arrived at. So the important bit to this is you can see there's those two rows now, the surplus and shortfall and the agreed amount. So what the advisor has done with the red rows, he's clearly demonstrated to the client that based on the needs analysis, the client actually needs 1,909,324,000 for life and TPD. He needs 150,000 for trauma and 96,000 per annum for income protection. But as we know, given the client voice and the objective and what the client wanted to do and it was agreed upon, the agreed amount in green is now $1 million for life and TPD, nil for trauma because it has been excluded from the advice, and $90,000 there for income protection. So again, another part of the SOA to make it really clear what the client needed, and then what's been agreed upon. So really important that you do complete a needs analysis in every instance, and we'll touch on in a second how you can determine some of those risks involved with being underinsured. So my next 2 slides are going to cover off on how you would capture the risks of being underinsured now that the client has directed the amount of cover they want, and we know it's less than the needs analysis. So there's 2 places to do that. The first is within the recommendations. So you can see within your best interest, and as we know, this is the section to link your recommendations back to the client objective, that the advisor again has made it really clear that after completing the needs analysis, the client needed, 1,909,324. However, due to concerns around affordability and the impact of the long-term super balances, they have agreed to lower the amount to $1 million, and this will discharge the mortgage and a remaining $400,000 to be provided to the family for emergency funding. So really clear link back to the client voice and the objective. And given the client's concern around cash flow, the advisors recommended that the policy be held inside super to reduce the burden on cash flow. The second part to capturing risk is within further details. So this is where you would generally capture the risk of not making contributions and how the amount potentially differs from the needs analysis and what the impact of premiums could be on the client's retirement. So you can see in that second paragraph there, the advisors made it really clear that the amount that the client wants is $909,324 less than the needs analysis, and they should be aware they're going to be underinsured. The important part to this is probably that last paragraph, and there's a couple of ways you can capture this. So in this case, the advisor has decided to do it in text format. So what the advisor's done is he's made the client aware that the insurance premiums are going to represent X amount of the overall SG contributions. And if the client doesn't make contributions, that the calculations show that this could reduce the client super balance by X amount, which could have an impact on their lifestyle down the track. The alternative to this is to use projections. What I've been finding personally is that advisors who use software generally use projections because the software will allow for that. Either of our methods is allowed, but it is very important that you capture to the client the risk of not making contributions and what that actual impact would be to their long-term retirement benefits. So the second place to demonstrate to the client the impact of being underinsured is within the other potential loss benefits and significant consequences. So this is one area that I definitely find that advisors do fall a little short sometimes. There is a document on the Advisor Resource Centre by the name of the Demonstrating Best Interest Guidelines. It's a document you've probably heard the compliance managers talk about before. It's one that I use with the advisors that I work with. It's definitely worth having a look at because there are some tips and tricks there around how these areas of the SOA can be addressed. So it's a document worth looking at. So this section of the SOA is to demonstrate to the client how taking a lesser amount of cover might impact them in the event of a claim. And it's about being a little bit more specific to the risks involved. So as we can see in that first paragraph, the advisor made it really clear that the client only wanted enough money to repay the principal place of residence and produce enough for a lump sum. But the client should be aware that this could mean that in the event of death or disability, that the family might need to sell off other assets, such as the investment property. That they might have a share portfolio to assist with paying down other debt and even to cover some of the shortfalls that the needs analysis determine, like income replacement or education costs. And it's important, again, that the risks around, not making additional contributions is captured, making it really clear that the client didn't want to do this at this time, and it's important that this be reviewed regularly. I guess in summary, client-directed cover, make it really clear in the client voice after discussions with the client what they want to do and why they want to do it. Ensure your scope of advice clearly captures that, provides a good link to some smart objectives, which will then easily allow you to link to your recommendations and capture those risks appropriately. That's it for me. I will pass you on to Beck.
Hi all. All right, so I'm going to be focusing on gearing advice. Essentially, there's been some recent questions in relation to gearing and where debt recycling fits in. So I'm going to focus mainly on those areas today. So we will go through what's required when you write gearing advice, what constitutes gearing advice, and the key differences in regards to it. So one of the standard questions that we tend to get a lot of is, am I required to undertake additional training or accreditation outside of the standard margin lending authorisation in order to give gearing advice. Now, the vast majority of our advisors will have margin lending standard as part of their AR authorisation. So the simple answer is yes. You must have undertaken a specialised gearing or margin lending accreditation to give advice in the following areas: lump sum instalment gearing, so margin lending, protected equity loans, instalment warrants, SMSF LRBA arrangements. On top of that, with the LRBA arrangements, you must have an SMSF qualification as well. Please refer to the SMSF policy. In regards to the course accreditations, you may have conducted that through an advanced diploma, bachelor or master's degree through your recognised learning providers. In relation to that, if you have not done a course, they are available through the Stockbrokers and Financial Advisors Association, Kaplan, Integrity or other financial services learning providers, or via university degrees such as Masters of Financial Planning. If you're unsure if you have an required accreditation and whether or not you are required to conduct this, you need to get in touch with us. Okay, so what constitutes gearing advice? What are the strategies and topics? Gearing is a strategy of borrowing money to invest. It's that simple. It is if the source of the funds for investment purposes are to come from borrowed monies, this is considered gearing advice. Uh-oh, what have I done? Okay, I've just done.
It's all good.
My little screen. Oh, there we go. I can make it bigger. Sorry, I've just realised that I can alter the technology so I can actually read the slides. Excellent. Why do I need to take, I'll take a step back. So we classify the following areas as gearing: debt recycling, so utilising equity from your principal place of residence to invest elsewhere; lump sum or instalment gearing; margin lending; protected equity loans; instalment warrants; SMSF LRBA arrangements. That is gearing, the end. Essentially, why do we need to take more steps in the advice process when you're recommending gearing? It is required for PI cover predominantly. There are elements of this in regards to best practice, ASIC safe harbour guidelines, but most importantly in regards to our licensee standards in order to work out the viability of the gearing for your clients. Okay. What are the current licensee gearing advice rules? I'm not actually going to run through this in entirety. What I want to really do is essentially point out that we do have gearing rules. There is a licensee guide business principle, investment gearing it is called, on the Advisor Resource Centre. I wanted to bring to your attention the following rules. Essentially, this covers margin lending and LRBA. We have undertaken a bit of a review in regards to debt recycling, and that'll feature in the next part of the presentation. So this is just the second part of it, just a little bit more on that investment gearing. So what are the proposed changes to the gearing rules? So I had an inquiry from one of my Queensland advisors the other day. I tend to get a few in relation to debt recycling a lot. In relation to it, I'll run through the example first of all. The clients are husband and wife. Husband is a high income earner and the wife is a stay-at-home mum. He has a share portfolio worth around $100,000. So the income, etc., via the dividends is added to his taxable income. The advisor wanted to suggest altering the strategy whereby they sold down the investment portfolio, paid that against the principal place of residence, and then drew credit facility off the home loan and to use that for investment purposes. Essentially using that money to then reinvest into an investment portfolio and then invest that in the wife's name. So the question was, is this gearing? Am I required to undertake the investment gearing checklist? And do I have to do all of the steps that's outlined in the policy? My answer was yes. Essentially, you do. It is gearing. You are required to do the checklist and gearing. But what it did do is actually trigger quite an extensive conversation here in relation to debt recycling in particular, and essentially what constituted debt recycling advice, whether or not they did or should have to go to the same levels in regards to the margin lending standards or the LRBA standards. So I'm happy to report that off the back of that particular conversation, we have now opted for some changes in relation to gearing for debt recycling only. Okay, so this is specifically in relation to debt recycling strategies. So you will not be required to undertake a specialist accreditation in margin lending / gearing, but we do recommend you do. Change to the LVR position. So the previous example I had outlined to the advisor that they must not go over 50% in regards to the LVR. We have since looked at that position and taken on board the advisor's feedback in relation to the bank's criteria, because the banks essentially look at the gearing, the LVR arrangements and work out the credit advice in relation to that. So we're changing our LVR position in relation to debt recycling. So the client must meet the lender's criteria in terms of the allowable LVR, and under no circumstances should you make a recommendation on the percentage or the amount that the client should apply for. If required, you should refer this to a third party, and in no circumstance are you to give credit advice unauthorised. So therefore, based upon that, we have some further guidelines as part of this gearing update for debt recycling, the debt recycling update, I should say. This will be explicitly stated what is credit advice and what is not credit advice, and we'll have really clear understanding what you do need to do. We are allowing, in some limited circumstances, your clients to be classified as balanced investors as opposed to growth and high growth, which is still required for LRBA and non-LRBA strategies outside of this debt recycling. So margin lending will still require the clients to be growth and high growth. But in this case, for debt recycling, balanced investors may be suitable under limited circumstances. They must be assessed as having a long-term investment horizon and be assessed against the likelihood of harm should markets turn. The following elements of the checklist will stay in place for debt recycling. Clients' insurance or risk mitigation strategies still need to be considered, in particular income protection. The client's income source or ability to repay the loan must be independent or not dependent on the investment income. So you can't draw down the investment income to repay the loan and that be the source of repayments. Client must have the ability to understand the impacts of gearing and have the required risk tolerance and timeframes to tolerate such strategy. The client must be on an ongoing arrangement, so an ongoing service arrangement, explicitly with at least an annual review. There is no double gearing allowed in any circumstance under any gearing arrangement. You are not allowed to do double gearing. It is expressly prohibited. What that means is you cannot use geared monies to invest in internally geared or geared products. It is prohibited. You must still demonstrate the strategies in the client's best interest. Goes without saying. Advice is still required to come to pre-vet in circumstances where it's an initial debt recycling strategy and increase to the loan limits, or when there's significant changes in the client's circumstances. So if you're unsure, please call us or talk to us in compliance in relation to any of these matters. We will, excuse me, I'm in the process of updating the gearing policy for a final review for especially these debt recycling changes, and we will have that released early next week sometime. So what is the current gearing checklist? Where can you find it? And this is the place where you'll find the new gearing strategy policy, my apologies. So it's located under ART, it is under compliance, it's under policy, and it's called Policy and Checklist or Business Principles Investment Gearing. That has not changed, nor will it change. There will, however, be a change in relation to you will have an editable PDF and a PDF and a Word version of the checklist itself. I'm in the process of establishing that for other checklists, so it will make your lives easier. as you work through your gearing strategies, to work off your editable PDF and work through the process and make sure everything has been completed. You are required to send that gearing checklist to compliance when you send in your pre-vet, and you are required to have a completed checklist on file for audit purposes. Okay, so another question that we get all of the time is what resources and tools are available to make our compliance requirements easier? My response is always, have you logged into ARC recently? Have you logged into the Libertas portal recently? If not, please do so. There is many policies, there are many guidelines, there are many things available. What is now available, Anita has updated that to the website, is a new client file checklist. What this is start to finish your financial planning process. It is a minimalistic checklist, meaning it's not 100% foolproof. I can't guarantee that if you follow this checklist, you won't miss something, but I'm pretty confident it covers 95% of all scenarios. You will need to adapt this to your own business, processes, strategies, etc. And it has been updated to include things like the initial client engagement, TMD requirements, sole purpose checklist, attestations, new OSA, new fee consent forms, etc. And this is what it looks like. Some examples, so I'll leave this on screen for a little while. Essentially, it covers the different areas or process steps involved in the, as I said, financial planning process. So what other resources are available to you? As I said, if you haven't logged into the Advisor Resource Centre or the portal recently, these are the links. This is what they look like. They should be your go-to in all instances when you have compliance questions. This is where we store all of our templates. This is where we store all of our business guidelines, tools, forms, pro formas, policies, you name it, it's pretty much there. Who can help you? So in terms of technical or strategic advice, just wanted to give a bit of a plug to Centrepoint Alliance. If you've ever wondered who can help me with the technical side of financial planning, so for example, you're wondering about contribution rules, you're wondering what the downsizer contribution rules have changed to, or what the impending legislations might mean for your clients. A couple of examples, I had some advisors who needed to know about some specific products because they were defined benefit. And they were a little bit different to normal defined benefit products. And the people at Centrepoint Alliance were fantastic. So in terms of technical expertise, it's not something that we here in compliance will advertise or do. It's something that you need to be aware of, and the technical team can definitely help you at Centrepoint Alliance. And it's available to all Interprac and Libertas advisors free of charge. It's part of your AR conditions. Just a reminder, your compliance managers and PDMs by state, just in case you weren't aware. So Vic and Taz, so Shane Miller is your compliance manager and Samantha Amos is your PDM. New South Wales and ACT, you'll be looked after by Stephen Kallona and Glenn Loadsman is the PDM as well. In South Australia, Steve will look after you and Barry Straps is your PDM. For Queensland and WA, you have me. So I look after both Queensland and WA. Sharon Walker predominantly looks after Queensland and Barry Straps will look after WA. There are some slight differences there. Sharon has some advisors in Victoria and the like. So that is not strict rules. These are general guidelines. So don't panic. This is not a change. This is not me trying to tell you that you're changing your PDM. Your PDM is who your PDM is. This is general guidelines only. And that brings my part to an end. So I'll welcome Shane Miller across and he'll talk to you guys next. Thank you.
So I won't start my presentation just yet. There was a question which seemed sensible to deal with first. It was a question regarding the gearing checklist. And it doesn't, someone worried that somehow that meant they couldn't do LRBA advice for SMSF. So that is not the case. The checklist is not really applicable to that situation. It's for the non-super. For the non-LRBA cases, you don't have to submit a checklist. So if there had been a concern there, please put that to bed. All right, now starting. The,
Use the mouse to move the thing.
I'm sorry, what's that?
Just move the mouse to move the slides.
Oh, I see what you're saying to me. Thank
Yes.
you.
Cool.
All right, so starting the presentation correctly now, I was surprised to hear that Michael said I'd be sweeping up the rear. And in some respects, I thought to myself, maybe he's right, because there's been a lot of elements of what's been spoken about, which we'll touch upon today, but from a different perspective. Now, my perspective, or my frequently asked question is, which I get all the time, and sometimes worded better and worse, is why is my fundamentally good advice really need to be risk managed at all? And what does that mean to be risk managed? Now, again, if I refer to Michael, but briefly, we don't doubt that you give good advice. And our role is not to somehow challenge your good advice or to optimise it. We've taken the position for a very long time now that advisors looking at exactly the same scenario can recommend quite, well, if not entirely different, certainly quite different solutions, prioritising different elements, different products, a variety of things. So whether there's an optimal advice and somehow compliance is leading you or presumes to lead you in that direction, absolutely not. That's not our intent anyway. It's not our self-image and not what we're trying to do. What we're doing instead, in our opinion, is we're looking very closely at how you phrase your good advice. And in the process of working out how well it's phrased, it's to do with how risk managed it is, which means in its turn that you look over your shoulder a little bit at your work and you say to yourself, all right, could this be misinterpreted? Could this be the subject of dispute? And so on. An additional consideration, which if you'd been in the business for 24 years as an advisor, you may not have needed to do that in your early years. But certainly as I progress this presentation, I'll try to make the case that it's worthwhile to do. The only other thing then before we kick into the slides is that if this was just going to be a presentation around, penalties and things that go wrong for advisors, that would be, in my opinion, just an attempt to put fear into your hearts, which I think that's foolish. That's not really what the intent is. The aim here would be to help you to, and maybe you won't end up taking this view, but would be to help you see things a little bit the way we do. You may not end up agreeing with us, but you might then understand why it is we take the terminology we do, why we set up the templates that we do, why we set up the business principles that we do. And on that basis, then let's kick off with the concept of, is risk real? Now, if you look at your first slide there, you'll see that there's, if you break down the advice activity into giving advice and providing advice services, the AFCA, which was the complaints body, shows that really all the risk for advisors really lies, 87% in this case, with the actual giving of advice. Very little complaint activity arises from clients in terms of the services that you provide subsequent to the advice. It's the advice itself which is the risk element, and that's why obviously there's a fair bit of focus there. The surprising thing that if you look at all the complaints in 2020, only 36% of all the complaints that received to AFCA fell in the advisor's favour. Now, so this is not a fear thing. This is, in the end, right, a fact, but also how we're going to deal with it. And 36% isn't very high, obviously. Taken from the same information, though, if you look at the third point, and this is where I think this is quite interesting, advisors and licensees are unlikely to be successful if they fail to gain reasonable understanding of the client's goals, the client's objectives, and the personal or financial circumstances. You won't win. Now, I've not met an advisor in this licence, nor any other, nor have I ever met an advisor who didn't think that they were already taking into account objectives, goals and personal circumstances. People are offended if you take that view that they're not somehow. What I would draw from this third point is the fact that this point's being made at all by the third party who wrote the report, is that they're saying these things may be dealt with, but they're not necessarily being dealt with effectively, that they may be being dealt with superficially. And there is an art in the end to doing it well. Now, I'm just going to see if I can't move these slides on a little, bear with me. Okay, so of this first series here, we see that in 2020, a bucket load of money was paid out to complainants. When I say risk is real, it's numbers like this which perhaps put some flesh on those bones. And the average complaint that was paid out in 2020, just shy of $140,000. Now, of itself, that's eye-watering, I think. And it also, if you take the perspective that under your PI insurance cover, the excess of your cover is $35,000. So, there's a very real chance that, if these averages were to apply to you, and I'm not saying they're going to, of course, that would be just a fear thing. But if it were to apply to you, there's a fair chance you'd be paying all of your excess. These slides drill a little deeper because they're not looking at the aggregate of complaints. They're looking now at complaints by type. And, at a high level, we see here that superannuation related complaints, and later I'll explain more about what constitutes those. But superannuation complaints are the riskiest, you would think, given everything else, all else being equal, is the riskiest area of advice. Investments following second, and insurance coming somewhat third. The second graph showing us that insurances are more easily defended, it seems, when complaints are made. But it's very much harder to successfully defend a complaint against super and investment. And again, that will become clearer when we drill down into what the nature of those complaints are. Now, you'll be pleased to know I'm not going to repeat all the good work that has gone on from Stephen's presentation. But just to say this, about 5 years ago, Michael had the idea of changing the structure of our SOA template. And I was lucky enough to get involved with that. And over the last 5 years, the rhetoric or the terminology that surrounds those changes and the logic for them has built into something of a company-based sort of, language that you don't find used outside in the industry generally. Things like the advisor voice, the client voice, all that sort of stuff. But the template is built for no other reason really than to ensure that your advice, good as it is risk managed, and the format of it then enabling you to look back over your shoulder to see what you have written, to see whether it would withstand misinterpretation, whether it might stand a dispute situation, whether the goals and objectives have been more than superficially covered, and then that those goals and objectives form the basis going forward as the rationale for what it is I think is the thing you should do, Mr. Now, I said I'd be drilling down a little bit into some of these. Now, if you try to read it all, I think you'll go spare. So just let me pick out a couple of points. From the self-managed superannuation, and of course these slides will be made available, right? So what you can't read today, and if you're interested, they will be available subsequently. But the claims made against or superannuation, self-managed super fund related complaints last year alone constitute $22 million of payouts. And whilst we said 36% of advisors only won claims on average, when it was related back to self-managed super funds, your chances of winning a dispute were only 26%, so very much less. If you, and I suspect that maybe the slide is a little small, but if you look at the section headed, the SMSF complaints include, there are 5 bullets there. The last 3 things around inappropriate super funds. So just suggesting these things, perhaps for reasons which don't become entirely clear or doesn't suit the client objectives. Investment properties in super seems to be a very big risk area, together with the use of, or the recommendation for LRBAs. Now, this doesn't mean you can't do those things, or that you shouldn't do those things, or it's in the, is it somehow not in the best interest of the clients to recommend an SMSF? Of course it is. But the issue would be, how is it phrased? How can it be turned against you in a situation where you and the client fall out of love into the future, should that be unhappy and occur? And then it goes to complaint, and I can't keep repeating the implications in both dollars and percentage chances of you winning. If we move to gearing, where Beck spent considerable time, we see here that complaints paid in 2020, again, about 22 million, somewhat similar to SMSF. So these are high risk areas, okay? And it included such things as margin lending and mortgage lending. So using the sorts of things that Beck was referencing today are real complaints that get raised, and the chances of winning those are on average 23%, which aren't very high. And again, it's not even necessarily that it's your fault or that you didn't try to do the right thing. There is no implication of that. Remember, this is all about good advice you've been giving. This is about whether it's worked against you in the end, such as an unfairness of the way, in the environment in which we operate. Risk profiling and appropriate diversification, $37 million. Now, you would think risk profiling would be dead set easy, wouldn't you? But that's more complaints have been paid out against that than even SMSFs. Things like inadequate risk profiling and inadequate discussion and justification of asset allocations. Ongoing reviews of the client's asset allocations that just aren't done, aren't known, aren't properly researched. These constitute considerable complaint. Appropriate advice, which is the fourth quadrant of this slide, $36 million. And the summary there references the strategy recommendations, typically not being in the client's best interests, are sort of the main areas of complaint, together with the suitability of recommended products to the client's relevant circumstances, which of course that relevant circumstances echoes the FASEA code in particular. Now again, I don't meet advisors who don't think they do this. If there are some of you out there who don't think you give a damn, well, I haven't met you yet. Most of you think you do. And what I'm saying is, I would say most of the industry thinks they do. So what is the difference? The difference here is if everybody's thinking of doing it right, but it isn't happening, then is there time for some reflection and taking a different perspective? I'm just not giving good advice, but managing it well. Let's move on because time is getting away. $35 million paid out for disclosure of risks, things like liquidity, affordability, which of course were the key matters raised in Beck's spreadsheet, checklists and gearing checklists in particular. The fact that there's a reference there to asset allocation variances. How many times have we seen advisors forget those sorts of things, and in the end they become potentially something that can be used against you? Of course, I haven't said how they're used against you. I'm just picking out that they're there. Know your client. Incomplete fact finds then seem to be substance of these complaints. Incomplete risk profiles. Not that they don't do these things, but incomplete, not comprehensive, not covering, the client's broader financial circumstances, again, for SEA, and that in its turn then allowing the advice to be criticised after the passage of time. Maybe, again, I say unfairly. And the last one I'll choose to pick on, and this is in the fourth quadrant there, the costs of changing products, where people do switching and they move clients into higher cost accounts. That's not the only thing that's under that, but that's one I just pick out because we do see it. And unlike yourselves, who typically see your own work, we see your work and we see the work of all your compatriots, and in many cases, a lot of other licensees prior, to that. So we do get a context and we do get a vision, which even if you might regard it as being somehow too pessimistic, at least if this slideshow does nothing else, it will at least allow you to understand why potentially we take the view we do. But, as I say, in the context of an advisor doing the right thing, Just to finish then, there's 3 little case studies. They won't be done in detail. Again, the case studies give more information really that could be read later down the track. This was one about insurance eroding the value of super within a fund. I think the numbering, the complainant won is to the tune of $276,000. Must have held a lot of premiums that were being paid there. And of the AFCA key findings, some of the, and which I've sort of circled for you there is no evidence that the advisor reviewed the SMSF's life insurance policies. Now, what that might mean is, of course, that the advisor has come in, perhaps, focused on what the client thought was the need, maybe investment need, and the broader financial circumstances, the advisor felt perhaps I wasn't being asked for that. I didn't need to consider that. And therefore the insurance has been forgotten or put to one side in an attempt to be not just efficient, but to be genuinely helpful. But that can bring you undone. Similarly, AFCA was satisfied, in this case, let me read the last one. AFCA was satisfied that a prudent advisor acting in the client's best interests, having regard to the self-managed super fund deteriorating financial position, would have reviewed the SMSF's insurances and recommended a reduced level of cover. Now, in some respects, that's the same thing. I mean, you just didn't deal with insurance. But the interesting point here is that if you had looked at insurance, would you have considered even reducing the level of cover? I don't see that very often. And that doesn't mean that it's always important that you reduce the levels of cover. But certainly, AFCA thinks there's a case occasionally for its suitability and appropriateness. And as I say, that was a big loss in terms of dollar terms. The second case, 2 of 3, was again, this time not $250,000, it was only $10,000. I beg your pardon. I went to number 2, isn't it? I'm looking for that. There it is. In this case, the complainant only won $10,000 back, so I think not so important. I'd hate to find that money out of my excess. And this one, no fact find, file notes. Now, most of our advisors do fact finds, whether they're comprehensive, we already mentioned that. File notes, a rarity, essentially, a rarity. And they can bring you undone because they give a vision into your thinking, they give a vision into the client and your understandings. They give a vision then that can be used in your defence should a dispute arise. In the last box there, AFCA considers it good industry practice to write down a client's objectives in the words the client has used. Now, those of you who have sat at my feet, and Steve and Beck, how many times you've been discussed this client voice being an echo? Steve used it today, where we're trying to get the client voice. We're trying to get not your summary of what they said, but what they said themselves. And people feel that, I think, it's a bit of an imposition on occasion. But here's a case where it's actually quoted by AFCA as being the reason in this case that the case was lost to the advisor because he couldn't recreate what the client wanted in any sort of meaningful or effective fashion. Nor did he, as it said here, detail how the strategy would achieve the client's goals. Just to finish now. This last one, $55,000, around the issues of switching funds. This client presumably came in, you'll see it in the first one, and they were unhappy with their customer service. This could have been, I guess, a client who comes in and says, I'm unhappy with my investment performance, or I'm happy with one of the other things. In this case, customer service. So the advisor said, yeah, I'll put you in a fund that'll do better. They'll give you better performance in this instance. Better service, I mean. In the last box, they lost the case because the specific customer service needs, which the client said they wanted, were not necessarily able to be shown to have been met. In other words, there was a glib promise, it'll all be better. But nevertheless, it was never demonstrated or even what the better would look like. So consequently, when it was put to the test, the case was lost. So is risk real? Should we manage risk in addition to just giving good advice? My suggestion to you is we should manage risk, but, and this is the last point, everybody's quite as comfortable with the thought that there's risky advisors out there. Nobody sees themselves as the source of risk because we're all doing the right thing. I suspect all those advisors thought exactly the same. So you are doing good work. We commend you upon it. We do ask you, even in humility, to look over your shoulder occasionally, to protect yourself. You're doing a good job by the client. And if you can avoid some of these issues for yourself, that'd be brilliant. Thank you.
All right. So we've probably got about 7 minutes left for some additional questions. I can see that.
Must have been answered.
Yeah, they can only see me. That's interesting. I'll roll back. They can see Steve. Shane's here too. Here we go. Here's the three of us.
The monitor.
Right. Okay. Cool. Perfect. So essentially, got a few minutes left. I wanted to raise a question because I had a call from one of my advisors yesterday, and it comes up from time to time. We spoke about it this morning, just in relation to whether or not a financial planner can act as a trustee for a trust for one of their clients. So this example was a Queensland advisor rang to say he and another party were a trustee of a deceased estate in his capacity as an accountant, and essentially the family trust had been, he was not a beneficiary, and one of the trustees had to step back. Therefore, they had to create a corporate trustee structure, which he was then going to manage. The question was, is there a conflict of interest if I act for that trust as a trustee and as a financial planner? The simple answer is yes. You have a conflict of interest, and we want to limit those conflicts of interest. Even though he may not be a potential beneficiary of that trust, there is a potential conflict of interest which we want to avoid. So in those circumstances, this might apply to if you're an executor of an estate as well. Can you also be the financial planner?
Vic, you're looking at me for that.
We've spoken about this before.
Yeah, we have spoken about it
Yes.
before. So the simple rule is that we don't want financial advisors being executors or trustees in these things. Unfortunately, there are times when a client is left with no other option but to have their financial planner as being fulfilling that role. If that's the case and you get our approval to do it as a conflict of interest, you will actually be required to surrender at the time, if you're an executor, at the time you commence your executor's duties, any advice to the estate. because you can't give advice to yourself. And that's really the simple point to it. You know, we never want you to be put in that position where you're being asked to give advice to yourself.
Perfect. I wanted to make a couple of corrections. So Steve's earlier needs analysis had $20,000 in the TPD benefit for a funeral benefit as part of TPD. That's an error. We will fix that. Thank you for highlighting that. And there was another question about the trauma, which was how did we come to the 150,000? It was a medical expense, and that was, I believe, noted in the assumptions/notes. So essentially, another correction, Shane's slides on the complaints, the amounts quoted was actually complaints paid out from 2012 to 2020. So in the past 8 years, there was 27 million paid out in the last 8 years as opposed to 2020. So that's another correction. I think a lot of the other questions were covered off by Michael and Gary as we went through the presentation. I don't think that there's any other questions that needed to be answered.
Can I just jump in with a couple of points? And Steve and I had a discussion with a prospective new business yesterday on very much the considerations that need to go into deciding on the insurance needs analysis. And there has to be two considerations in all of this. There is the client needs and the client affordability. And, you know, the first thing that needs to be decided upon is what are the client needs. And they will often be a very large amount by the time you work through the needs analysis. But it is about understanding from those what actually is it that the client is looking to achieve in their as the goal for insurance. Is it just covering debt? Is it keeping the family in the style to which they've grown up and the like? And that will come into the consideration of what the needs analysis. And then, of course, you've got, well, what really is affordable? And we've seen in the complaints there that, unfortunately, one of the areas that often comes up at AFCA complaints is that the advisor should have looked at my position and I was overinsured or whatever. And you know, there's not always an easy defence to that. We, as a group, we haven't lost any in that regard, but it is certainly something to consider there, and taking into account what impact on my superannuation are the insurance premiums having, and do I need to review that? And at the very least, there should be the notes that say that these have been looked at and the reason why there is no change. And for most occasions, if you've got insurance, you've taken that insurance in the first place for a need, and it hasn't been changed in the future. So all of those need to be taken into account.
Yeah, and just off the back of that, there's one thing that there's two parts to the contribution side of things and the cash flow, the incidental cash flow when it comes to scoping and needs analysis and whatever. I'm often asked, is there at some point that I should consider how much of the client's SG is being taken up to pay the insurances? If you look at that case study number 2 or 3 that Shane just presented in regards to the SMSF having the large payout for not considering the insurance, you'll actually see there was a clear indicator there that the SG was about 25%. Sorry, the insurance premiums represented over 25% of the client's contributions. And that was part of the reason that AFCA found in favour of the clients and paid out. So considering the incidental impact and the explicit impact that you'll use up of the SG in order to pay for insurance is something I bang on about with my advisors all the time. There's no golden bullet. There's no golden rule. It simply comes down to, do you think it's in the client's best interest to contribute? Do they have capacity to contribute? If so, recommend it. It is up to the client to then decline the advice and not implement that salary sacrifice or contribution strategy. That way they bear the risk. It's that simple, guys. We're out of time. We're over time.
Yeah, well, just before you go on, Gary's asked me just to give some colour around some of the loss calculations that AFCA do, and you know, unfortunately, the lunatics in charge of the asylum that are AFCA, very, very few of them have any idea of business. And so they sit there, they've come out of community legal centres and all of these other places that are home to that sort of individual. And in perfect hindsight, they can actually go back and select funds that operated well over the period, rather than what may or may not have been logically set up at the time. So we've had situations where they've done a loss calculation for somebody who invested in a lot of direct international shares, and their loss calculation was based on the fact that these people were so conservative that they would only invest in an ETF-based balanced fund. So, you know, don't get over anxious about these things. You cannot give advice that would be bulletproof at AFCA. The point is that what you need to do is give us the grounds to defend, because we will always go, and I will always go to bat for our advisors. And if you keep good notes, if you make recommendations that are in keeping with best interest duty, and if you remember whilst you're doing it that you may have to explain that advice at a later time. So, you know, don't make it without the thought and the presentation. If you do that, then if there is a complaint, and unfortunately we've seen an entire industry in the last couple of years spring up about making complaints, if that happens, you know that you will have the licensee and me with 20 years of butting heads with AFCA fighting on your behalf. So, you know, that's all I can say. Don't let it cloud your advice trying to be perfect, because it doesn't exist. Just make sure that you give yourself the best chance of having a complaint defended. Now, I'm eating into your break time, so if you've now only got 10 minutes to go and have a cup of coffee and be back.
Don't forget to wash your hands as you go to the boys' room.
Our next presentation promises to be